HMRC is collecting more tax from your savings than ever before, and it's only getting worse. But the good news is there's legal ways to keep more of your money in your pocket rather than HMRC's. So here are 8 ways you can avoid paying tax on your savings interest. I think we should quickly go through how savings and savings interest is actually taxed so we can really understand it. So one of the most important variables when it comes to the tax you're going to be liable for is the income tax band that you find yourself in. And that's because the marginal rate you pay will also apply to your income from interest. So those rates are 0%, 20%, 40% and 45%. Now, these bands have been frozen until April 2028, but I think at this point there's nothing really to indicate that they're definitely going to be increased after that. And if they do, the increases are almost certainly not going to be in line with inflation and will be marginal at best. Now, because income and interest are treated the same way from a tax perspective, make sure you keep an eye on this to make sure that your increase in income or increase in interest doesn't take you over into the next tax bracket. Because take a look at this. This shows the personal income tax allowance, basically the amount that you can get paid every year and not have to pay any income tax. You can see that this has been frozen since 2020, but even before that, it was only increased by an exceedingly generous £70 from £12,500. But without being all doom and gloom, there are some allowances. So we just mentioned that the rate is tied to your income tax band. So take a look at this here. If you're a basic rate taxpayer, you can earn £1,000 tax-free. This is known as your personal savings allowance. But this is tapered depending on your income tax bracket. It goes down to £500 a year if you're a higher rate taxpayer, and then you get nothing if you're an additional rate taxpayer. But on top of that, you also have the starting rate for savings. The starting rate for savings, which lets you basically earn £500 of savings interest tax-free. But you can only qualify if your other income, so basically your retirement income from pensions or your wage, must be less than £17,570 a year. Basically just your personal allowance at 12.5k plus the £5,000 allowance. If your income is over £17,570, then it tapers. So every £1 of income above your personal allowance reduces your starting rate for savings by £1. Why do they make these things so complicated? So how much tax will I pay on my savings? So basically the more money you have in savings and the higher income tax band, the more likely it is that you're going to have to pay tax on your savings interest. So now we've covered how they tax your savings, let's go on to why more people are paying tax on their savings. Take a look at this, quote, "The number of people paying tax on interest from their savings has jumped significantly. A Freedom of Information request from investment platform AJ Bell found HMRC expected more than 2.73 million people to have to pay tax on their savings interest in the 23-24 tax year. This includes 1.37 million basic rate taxpayers. That's a rise of around 1 million overall on the 2022-23 tax year. Back in 2020-2021, fewer than 800,000 savers paid tax on their savings interest. But now we understand how interest income is taxed, that leaves us with an important question to answer, which is, why are more and more people getting dragged into paying more tax on their savings? Well, it's a good question, and there are really 2 or 3 main reasons. The first is maybe the most obvious reason, which is the Bank of England started to raise interest rates at a truly breakneck speed. This was to try and quell rising inflation that saw the Bank of England increase rates to their highest levels in 16 years. Now, this has meant that banks have been paying out the best savings interest rates in well over a decade. And so as the Bank of England base rate has increased, so too have the interest rates on savings accounts. This means that an increasing number of savers face handing over some of their interest payments to the taxman. And frankly, gone are the days where you needed to have tens or hundreds of thousands of pounds in savings to worry about paying tax on it. Take a look at this here from Charles Stanley. This shows how much a basic rate taxpayer will need to have in their savings account at various interest rates before having to hand over some of it to HMRC. You can see here, starting at 1%, you would need basically £100,000. But at a time when you were frankly lucky to get 0.1%, you needed vast sums of money in a savings account to even worry about paying tax on it. And when you consider that even run-of-the-mill savings accounts get you 4.5% upwards in this day and age, it should be more of a concern for more people. Now, the second big reason is pretty much that every single allowance or tax band or tax threshold that we've been discussing has been frozen for the last few years, and most are expected to stay frozen until 2028 or beyond. I'm thinking specifically here about the personal savings allowance and income tax bands. The long and short of it is that this means that more and more people will end up paying tax because they're more likely to go over those thresholds. As their pay increase, as interest rates go up, more and more people just get dragged into those higher rates. But there is good news. There is plenty you can do to shield your savings from being taxed. So here are 8 ways you can avoid paying tax on your savings interest. The first, and maybe the most important one, frankly, that we should be discussing at this point is the ISA. Now, there are quite a few different options here, but the one thing that we really should be clear on is that ISAs have a different set of rules attached to each kind, and therefore they should be used in different ways. One thing that I see frankly, all the time is people using the wrong kind of ISA for the wrong kind of job. So we'll use this as a good guide about how you should be using your ISAs as well. Anyway, back to it. So an ISA, or individual savings account, is an account which allows you to save and invest tax-free. Everybody has an ISA allowance every year worth £20,000, which you can use to invest in one or more types of ISA. Your ISA allowance expires at the end of the tax year on the 5th of April, and any unused allowances will be lost. That means you can't roll it over the following year, so if you don't use it, you lose it. And the first ISA on this list is the cash ISA. Now, for the most part, these work just like ordinary savings account, but all the interest that you earn from that account is tax-free. You may get better rates when fixing for a set period of time where you have to lock up your money for 6 or 12 months or even longer. Now, there are a couple of different kinds. With instant cash ISAs, you can withdraw money whenever you want to, but with fixed-term cash ISAs, you'll get your money back at the end of the term, and chances are you get a slightly better rate. Some accounts will allow for early withdrawals, but there might be penalties attached to it, so just watch out for those. Now, immediately, you might look at the cash ISA and just think, well, isn't this the silver bullet to all the problems? You have money in a savings account, you're running the risk of being charged tax on it, so you just transfer that money into a cash ISA. But the truth is that, in my view, the rates that you get on cash ISAs, even when interest rates are this high, are not great, even if you lock your money up for a year or more. It's also worth noting that when interest rates were rock bottom, the incentive to use a cash ISA was pretty much zero. You needed so much money in a cash ISA to be getting close to those limits, and frankly, you could put your money to work and get a better rate of return with other investment options, like our next option. Next up, we have the Stocks and Shares ISA. A Stocks and Shares ISA is effectively a tax wrapper that can be put around a wide array of different types of investment products. And the big benefit is any investment growth or interest earned within a Stocks and Shares ISA is completely tax-free. Now, this is starting to sound a bit more promising. So what that means is you can buy shares, ETFs, index funds, corporate bonds, government bonds, and a whole bunch of other potential investments and shield yourself from future tax liabilities. And it's probably worth mentioning this really important point, which is that the average return you'll make by having your money invested will generally not just outpace the return that you'd get on having your money in a cash ISA, but also critically outpacing inflation. Typically, average returns for the stock market, like the S&P 500, have been between 8 and 10% a year. And we've always said on this channel, the Stocks and Shares ISA is one of the critical tools that we have in the UK for building wealth. So don't overlook this one. We have Innovative Finance ISAs. An Innovative Finance ISA is basically a tax wrapper for peer-to-peer lending. Holding these in an ISA means any growth on the investment is not subject to taxes that would normally be paid on the growth or interest. I don't want to really waste too much time on this one, so we'll move on quite quickly. Next, you get to your lifetime ISAs. A lifetime ISA can be opened by anyone aged 18 to 39, and they offer a 25% bonus on savings used for retirement or buying a first home. If you pay in the maximum £4,000 a year, that means the government will give you a bonus worth up to £1,000. And importantly, the amount you pay in is linked to your annual £20,000 ISA allowance limit. For example, if you pay £1,000 into your lifetime ISA, you can still pay in £19,000 to other ISA products like the Stocks and Shares ISA. But also another important point which often gets overlooked is that the bonus that you get from the government doesn't count towards your £20,000 limit. Now, I want to move on to a much less talked about ISA, but that I still think is really marvellous if you have kids, and that is the Junior ISA. So this is a separate ISA and therefore has a separate allowance attached to it. You can pay up to £9,000 per year per child, and this will not get deducted from your £20,000 annual ISA allowance. And because it's an ISA, no tax is due, and the money belongs to your kids who can access it once they reach 18, but they'll be able to manage it from the age of 16, so bear that in mind. Now, the general criticism of the Junior ISA, which is a fair one, frankly, is the money is locked away. So kind of like with a pension, if you pay money into your ISA, you can't get the cash out until your kids turn 18. So generally sound advice has been to not bother with a Junior ISA unless you've maxed out your own £20,000 ISA limit every year. And I think that for the most part, this is reasonable advice. But my only input is that, and this is a personal preference I would add, is that I like to have money divided up so I can see what balances are in each kind of account, but that's just me. Moving away from ISAs, now we have premium bonds. Premium bond wins are also tax-free. You can contribute up to £50,000 a year and a minimum of £25. And once the money has been in your account for a month, you can enter it into a monthly prize draw, where you can win from £25 all the way up to £1 million. NS&I calculates that the annual prize rate is currently about 4.15%, but some people win considerably more and others will win less or absolutely nothing. Now, personally, I don't think too highly of premium bonds because the stories of people who get $1 million get blown out of all proportion. You won't often see a news article or hear of a headline of someone who only won £25 or worse, nothing at all. Next on the list, we have pensions. So money invested into your pension gets tax relief, and it also has the added benefit of reducing your taxable income because your income tax is calculated after pension deductions. You also get the benefit of your employer matching contributions, effectively, depending on your employer, letting you double your money and getting tax relief on it as well. But for saving interest, if you can use a pension contribution to go from being, say, a higher rate taxpayer to a basic rate taxpayer, then, as we've talked about, that'll double your personal savings allowance from £500 back up to £1,000. And this is a really valuable benefit that helps your money grow much faster. But it is worth remembering that you won't be able to withdraw that money held in a pension until you're 55. This is going to move to 57 from April 2028. And one final one, which I admit is an extreme measure, is the junior SIP, which is basically kind of like kids' pension. You can save up to £2,880 in a pension for your kids, and the government will top it up with an extra £720 in tax relief. Now, your kids won't be able to access that money until they turn 57, so this is for the super long-term thinkers, but it does often fly under the radar, and I think it can really help to play an important part in planning for your kids as well. Now, watch this video right here where we have 7 financial rules that the rich follow but broke people ignore, or this video here where we talk about 40 harsh money truths I wish I'd learned in my 20s. Thanks very much for watching Modern Money Talk, where we talk all things personal finance and economics related. If you've liked this video, please like and subscribe. And let me know, have I missed anything off the list? And what do you all think? Comment below. Thanks very much for watching.